Hello everyone, my name is Hitesh and I welcome you all to TradeBrains YouTube channel. Before moving on, if you're new to this channel, please comment, like and subscribe on our videos, and please don't forget to press the bell notification icon. So as and when we publish new content, you get a notification straight onto your device. Now in our previous videos on mutual funds, we had talked about the tax-free funds and we also talked about the blue chip funds. How do you choose a blue chip fund? Which funds are the best performing funds? Similarly, for a tax fund also we explained about what are different kinds of tax funds which are giving you tax saving plus decent returns. I'll be mentioning the link of those videos on our description. Please do have a look at them. Now through this video I'll be dealing with another sector or another kind of funds which are like the investors' favorite, and especially those kind of investors who want to have returns on their investment but still they don't want to take very high risk in the market. I'm talking about the concept of index funds. So let us understand what exactly are index funds, how do they behave in the market, what's the rationale, what does index fund comprise of. Let us have a clear understanding on those topics. So the first thing which comes to our mind is what are exactly index funds. So index fund is a kind of mutual fund with a portfolio constructed to track the components of financial index. Now how does that work? Supposedly I want to have an underlying index in the form of Nifty. So in the mutual funds, you have a portfolio which is constructed by all the shares which are part of Nifty 50. So Nifty 50 comprises 50 stocks. So mutual fund also comprises those 50 stocks and in the same proportion as the weightage given in the Nifty 50 for those kind of shares. So next important point is index funds gives you the power of diversification. How does that happen? As I already told you, it is a portfolio which is constructed based on an underlying index. An index always comprises a bunch of shares which are diversified into different sectors. So with the help of index funds also, your portfolio gets diversified because the investment is based on the investor on the particular index. These are generally very passive form of investment. And why so? Because the fund manager is generally investing the money in same proportion and in the same ratio as the index. And index always is diversified into various sectors which reduces the risk on the movement. So with the help of this fund also, your risk is diversified, which means the returns will be little on the lower side, but they'll have a stable growth in the returns also. And which is also the reason the index funds have a very low expense ratio. Why so? Because the funds are being invested in the same ratio as the components of index, and the components of index don't change that frequently, which is why the investment made by the fund manager in these kind of funds also don't change, which is why you have low operational and functional cost, and which ultimately reduces the expense ratio to manage this fund. And the predictability of return is very important, because in general if you invest in other direct mutual funds, that is the mutual funds which have been actively managed, you have a lot of trading going in those kind of mutual funds, a lot of buying selling happens. But in case of an index fund, your portfolio is constructed based on the underlying index, which is why you don't have too much of tampering with the investments being made. You can be rest assured that the performance of the index will in some sense be directly replicated in the performance of the index fund, which is why the return on the index fund is very similar to the performance of the index. So having understood what exactly are index funds, let us understand what is the rationale or how do you choose an index funds. We have shortlisted 5 factors. These factors vary from people to people, but according to our research and according to our analysis, these are the 5 factors which we should all be considering before choosing an index fund. So the first being the risk and return. Now as we know that the index fund is simply a replication of the various kind of underlying index which we are talking about, which is where when the index is performing really well, the returns on these kind of funds are very nice. As in when the index is going up, the value of your portfolio also goes up and you make a very decent return on the investment being made in the index fund. But when the market is coming down or when the market is having a period of slump, it is advisable to put your money in the more actively managed fund. So as in when the market is in a rally or as in when the market is going up, index funds are the best performers. But as you expect the market to have a slump or market to have a decent decline in the market, you can choose to invest in the more actively managed funds. The next being the expense ratio. Now the expense ratio in general is very low for an index fund. Why? Because they are not that actively managed as any other fund. The fund manager simply chooses those kind of shares which are part of the certain underlying index, and your portfolio is invested and diversified according to the weightage given to that particular shares in that index. So which is where the operational cost is very low and hence your expense ratio also is very low. So while choosing an index fund also, we should always choose the fund which has the least expense ratio. This point is very important because in general, a lot of people invest in the mutual fund with a mentality of trading. That is as in when the mutual fund will start performing well, I will be just taking out the money which I've invested, and I'll again wait for the market to come down. But in case of an index fund, as the index are volatile by nature, so in short terms you're going to see a lot of volatility in the performance of your fund. But if you're someone who's willing to hold it for a period of say more than 5 years, the returns in general average out, and you just get a stability in the performance of the fund, and you in general receive about 10 to 12% return on a yearly basis if you are a consistent investor and you're willing to invest for a long time. So it's a tip given by us that if you are looking to trade, then index fund is not the right option. But if you're looking to invest for a period of time, then index fund serves the purpose for that. And the next is that as the index funds are equity investment, so they are subject to dividend distribution tax also. What I mean by that, so as in when you receive the dividends on the investment being made by you, you have to pay a direct distribution tax of 10%, and that amount is directly deducted at the source, and the balance is being transferred to your account of mutual fund. And they are also subject to capital gains tax. So they are divided into two parts. If you are getting or exiting your position from the index fund within 1 year, so you on any amount of capital gains being made by you have to pay a tax of 15%. But if you are holding your index fund for a period of more than 1 year, so up to the amount of rupees 1 lakh of capital gains are being tax free, and beyond that any gain which is being made, you have to pay a tax of 10% on that. So capital gains tax also becomes a very important part of the index fund. So this is a small disclaimer by us. Now, having understood the various factors which you should be keeping in mind while choosing an index fund, these are some of the index funds which are being recommended by us based on our judgment. We don't recommend you directly to buy this, but these are the funds which are best performing in the market right now. The first being the SBI ETF Nifty 50. So as the name suggests, the underlying index is the Nifty 50. The asset under management is to the tune of 74,000 crore rupees. The expense ratio is the least in the category, that is of 0.07%, and it is giving a very good annualized return of 7.52% on the investment, which beats the industry average, which is 6.8% for this fund. So all the funds which are being given by us here are beating the industry average of 6.8%. And the portfolio diversification again is going to be more tilted towards the equity, and most of the funds have investment of more than 99% in the equity, because they have to align their portfolio on the weightage of different shares in the index. The standard deviation is slightly on the higher side because the index are volatile, which is where the risk also is slightly on the higher side, but which is compensated by the decent return given the investment. And the rating by the crystal agency is given you weightage, and we normally choose the ratings which are nothing less than 3 stars, but we go up to 4 star, 5 stars. So this fund has a rating of 4 star. Similarly, the ICICI Prudential Nifty ETF has an asset under management of 1500 crores, which is slightly on the lower side, but this fund is upcoming and this fund has been doing well, and it's giving you again an annualized return of nearly 7.5%. And that's got a 3-star rating. And similarly, if you come down a little, you see HDFC Index Fund of Nifty 50 plan, which is about 1800 crores of asset under management, gives you a decent return of 7%. Its expense ratio is slightly on the higher side, but it's being backed by a very reliable asset management company of HDFC Mutual Fund. So which is why this also becomes a part of our recommendation. And last but not the least, we also recommend the SBI ETF Sensex and the UTI Sensex Exchange Traded Fund. These are managed by the big fund houses, and they have a very decent amount of asset under management. Plus the fund is also being managed by a very reliable and a very strong team. They have an annualized return of 8.15% and 9.74% respectively, which means these two firms are the best performers in terms of returns in their segment, and plus they have a crystal rating of 5 star, both of them. So these are the 6 funds which we think are the best performers for index fund. You should use your own discretion while choosing one, but these are the funds which are being recommended by us based on our criteria which we have chosen. So I hope this video gave you a brief introduction into index fund. What is index fund? What are the criteria to choose an index fund? What is the benefit of choosing index fund? How is the index fund portfolio decided? And what are the various kind of index funds which are being recommended by us? I hope it gave you a decent understanding on that. If you have any more queries, please put your questions in the comment section. We'll be more than glad to answer them. I thank you for watching our video, and I hope to see you in the future videos of financial education. Thank you so much.